It's readily apparent that Donald Trump is fully committed to his campaign promises of tariffs, tax cuts, and immigration reform. Today, I'm going to take a look at what this means for the economy and for gold. Wall Street and economists share a wide agreement that this agenda will require deficit financing. Nonpartisan estimates of those deficits run from $7.8 to $15.6 trillion. By way of comparison, President-elect Trump's first-term deficits came to $8.4 trillion, while deficits over the past 4 years added another $4.3 trillion. With the national debt having surpassed $35 trillion, deficits of this size are expected to raise inflation. And at some point, the Fed seems likely to increase interest rates to cool the economy and combat rising prices. The Fed may feel forced to do this even if the economy is losing steam. Higher interest rates will undercut the housing, auto, and other debt finance sectors, thereby weakening the economy. Fed action to raise rates could also trigger White House and congressional attacks on the Fed's independence. This would reinforce market forces pushing interest rates and inflation upwards as global confidence in U.S. monetary policy erodes. In such an uncertain, risk-off environment, with stock values by most measures so inflated today, higher bond yields, that is interest rates, will draw money away from equities, weakening stock values and sending global investors to safer havens. Falling stock markets will make people feel poorer and lead them to curtail spending. Higher interest rates will also strengthen the dollar, reducing foreign demand for U.S. exports and raising the energy costs of oil-dependent countries like China, India, Europe, and Japan. Higher energy costs will weaken those economies. These pressures on our trading partners will intensify if the U.S. imposes the tariff the president-elect has proposed. Tariffs, being taxes on imports, will not only increase the cost of foreign products we buy, they are likely to trigger retaliatory tariffs by countries whose products we target. If so, U.S. exports will fall, our exporters will suffer, U.S. employment will decline, and our economy will weaken. As these dominoes fall, the current weak economies of China, Europe, and Japan will fall into recession. In China's case, worse, a deflationary spiral. Weakening demand in major world economies will reduce demand for U.S. goods and services. Wall Street and economic analysts are concerned that if the U.S. proceeds with mass deportations, the cost of goods and services dependent on immigrant labor, such as agricultural products and building construction, will rise due to labor shortages. This would add another source of inflationary pressure and undermine economic growth. The harbingers of higher inflation are already apparent. On November 12th, anticipating higher interest rates next year, U.S. banks issued $23.5 billion in investment-grade bonds, the largest single day of debt issuance by banks in almost 9 years. A day later, yields on 30-year treasuries rose above 4.6% for the first time since early July. This marks a sharp reversal of falling rates over the spring and summer. In mid-September, interest rates made an abrupt U-turn, rising more than 70 basis points and reflecting concerns about future inflation rising under the administration's agenda. So, in summary, these tariff, tax, and immigration policies are expected to increase inflation and interest rates while weakening stocks in the larger economy, both here and globally. Since most of the tariffs and some of the immigrant removals can be implemented without action by Congress, their inflationary and growth suppression effects will be felt relatively quickly. The administration's proposed tax cuts and most of its spending cuts will require congressional action. So, to the extent Congress ultimately approves them, their effect will be delayed a year or more. So the inflationary and growth suppression effects of this agenda will be front-loaded, while the uncertain effects of a combination of tax cuts and spending reductions will be backloaded. I should mention a caveat here. The economy might get a short-term boost as consumers, expecting higher prices and interest rates in the future, rush to buy housing, autos, and other high-dollar goods and services before everything gets more expensive. We're already seeing signs of this in so-called doom spending, where pessimistic consumers throw caution to the wind and make purchases they can't really afford, or they seek retail therapy by buying things that make them feel better. Watch for credit card debt and loan delinquencies to rise. Here's another caveat. If oil prices were to fall substantially and remain low, cheaper energy could partially offset the inflationary and growth suppression forces I've described. And this might be in the cards. OPEC has struggled to maintain prices despite lower production quotas this year. Those quotas are set to rise next year, and Saudi Arabia, OPEC's de facto price setter, has threatened to open the spigots to discipline OPEC's quota-cheating producers. If this were to occur, we could see an abrupt fall in prices that would reduce inflationary and growth suppression pressures in the global economy. So what does all this mean for gold? We know that gold has a centuries-long record as a safe haven in times of great economic turmoil. What I have described here is certainly in an environment of uncertainty and turmoil with many unknown and unknowable risk. We also know gold's reputation as a hedge against inflation. Now we understand the risk of higher inflation posed by tax cuts, tariffs, and labor shortages. But what is gold's track record during recessions? Does it offer wealth insurance in a cratering economy? It does. Gold prices rose 25% during the 6 months around the short COVID recession of 2020. And as other asset classes suffered during the great financial crisis and the 3 years of rough waters that followed, gold rose 150%. What else can we expect for gold? Huge purchases by central banks, particularly the People's Bank of China, have been a major driver of gold prices during the rally. The PBC paused its purchases last May, awaiting prices to fall before resuming its long-term diversification into gold. The PBC is doing exactly what we recommend to clients. Use gold to diversify your portfolio and buy on the dip when prices are falling. Prices are now where they were in early September. So if you have kicked yourself for not buying when prices were lower, here's your chance. I expect to see central banks returning to the market by year end. Purchases by the Chinese public have been another major driver of prices as they've sought one of the few safe havens available to them. China's economy is a basket case, and the middling recovering efforts of its government have had little positive effect. War has for centuries led to great increases in gold demand. The current rally began with the Hamas attack on Israel in early October 2023. That conflict has now expanded to 4 other Middle Eastern countries and drawn in the U.S. and its European allies. In the meantime, the war in Ukraine has intensified and spread into Russian territory. China has become more aggressive in the South China Sea and the Pacific. Chinese President Xi has ordered his military to be prepared to annex Taiwan by 2026, with the goal of doing so by 2030, using force if necessary. Add to these geopolitical tensions the prospect of a global trade war waged with U.S. tariffs, retaliatory tariffs, trade barriers, reshoring of manufacturing, and onshoring of strategic resource development. And we should expect international conflict to be a continuing force lifting gold prices. What I've described here is a world in which investors of all stripes will be seeking safe havens and low-risk opportunities for price appreciation. In the past, safe haven buying would have meant buying U.S. Treasuries and gold. However, U.S. Treasury investors have been burned recently as interest rates rose faster and longer than expected, making bonds a less attractive alternative. As bond prices tanked, gold appreciated 42% since the rally began and 29% this year. Besides driving interest rates higher, how does rising government debt play into this picture? U.S. media have a single-minded focus on U.S. government debt. Yes, it's big and it's about to get a lot bigger, but the world is swimming in debt, government, corporate, and personal debt. Public debt in the U.S. is a mere fraction of total all sources Chinese public debt, now approaching 200% of GNP. And trends in China's economy and demography suggest debt will be a much bigger problem for them than it is for us. Many other nations also have very high debt burdens and will be issuing huge amounts of additional debt to fund their basic operations and their development ambitions. All this debt will test the global market's capacity to absorb it and will raise interest rates worldwide. It may also lead to big, perhaps massive sovereign debt defaults, along with the political and economic instability that always accompanies them. This is a perfect storm of forces for gold. Rising inflation and interest rates, falling stock values, slowing economies, central bank gold buying, Chinese public buying, sovereign debt crises, and intensifying geopolitical conflict. These will, in tag team fashion, assault investor portfolios for the foreseeable future. We have witnessed these same forces at work during the 13-month rally, during which gold has surged by 42% even after the recent price correction. All of these forces will be in play. In fact, they are intensifying. Today's price correction represents an extraordinary opportunity to buy gold on the dip at the price it fetched 60 days ago. I strongly recommend adding gold to your portfolio for the wealth protection it affords and for the extraordinary price appreciation opportunity it offers, especially now.